The world of tax is a scary place, and the last thing that anybody wants is for HMRC to be interested in you. We are in an era where we see celebrities in the headlines every other week, and this video is going to break down the legal and, less importantly, illegal options which are available to you in the UK. Firstly, if you are paying lots of tax, it usually means you're making lots of money. And putting politics and social justice to one side just for a minute, it's generally a good thing if you're paying lots and lots of tax. The other saying is, don't let the tax tail wag the dog. Now, this one's less straightforward, I'll be honest, but what it basically means is that you shouldn't choose an investment opportunity purely for the tax breaks. Usually what it means is that if that really tax appealing option actually went to zero, it usually means you'll be in a worse position than if you had just invested in something that was pretty solid, but was less tax efficient. I'm going to categorize your tax options in the UK into three pretty clear buckets. Bucket one is illegal and sketchy. These are the ones that we tend to see the headlines about. Bucket two is legal and risky. These are things that you're well within your rights to do. However, they do come with increased risks, so they might only be right for a certain type of person. And bucket three is legal and solid. These are well adopted, sensible, sound things that everybody can make use of in their daily life. Now, I won't spend too much time on this, but let's take a closer look at the sketchier side of things. If we look back over the last few years, there are a few very clear examples of celebrities being investigated and then penalised by HMRC. These include Ron Weasley, actually Rupert Grint, Gary Lineker, and Jimmy Carr. Now, let's take a closer look at Ron Weasley. So back in 2011, Rupert Grint actually received a payment from a limited company of his that basically managed most of his work. It would have held the contracts for all of the income that he received from the Harry Potter films. And he received a chunky payment from that of £4.5 million. Not bad for waving a wand around. But the sticking point here is the fact that Rupert, and I assume Rupert's accountant, actually said that that payment should be treated as a capital gain. And as a result, it would only be taxed at 10 or 20%. Now, the reality was HMRC took a closer look at that and said, no, that should be treated as income and therefore taxed at Rupert Grint's marginal income tax rate. And that's a whopping 52%. And that ultimately has generated the £1.8 million bill that Rupert Grint now has to stump up in order to level the books with HMRC. For Gary Lineker, at the core, all that he was trying to say was that he is not an employee of some of his main contracts or things that took up his time, such as appearing on Match of the Day or presenting many of the sports programs for the BBC. He claimed that he was a contractor or employed on a self-employed basis. And what that means is that he can actually pay a much lower rate of income tax via a limited company than otherwise he would have had to as a fully employed person, like you or me, I suspect. Now, it is worth noting with Gary Lineker that actually they have settled out of court. So we don't really know what the payment would have been, but it looks like he's been successful in the way that he structured his contracts. And wrapping up the sketchy section, maybe the sketchiest one of them all, which is Jimmy Carr. He basically used a scheme whereby he would get a job, then he would resign from that job and get re-employed by an offshore company. That offshore company would receive his salary, and they would pay a very small amount of it to him and actually lend him the rest of the money. Now, because that's a loan, that can basically be written off for tax purposes. And it brought his effective rate of tax down to 1%. And in the world of tax, if it sounds too good to be true, it probably is. And Jimmy Carr was found out about this and had to repay all of that unpaid tax in good time. Now, really, the common thread through this is that the sole aim of much of what these celebrities were doing was just to avoid paying tax. And that's the difference with the next two buckets. They actually have a benefit for somebody beyond just paying a lower tax bill. And ultimately, that is what makes them legal and very available for people to use. Okay, enough of all the illegal stuff that actually isn't that helpful to you, but kind of interesting. Let's talk about some things that are available to you if you're the right fit for them. And for this first bucket, these are still very, very risky options. And so not everybody is going to make sense to use these. Really, they should be reserved for people who are experienced investors or high net worth people who ultimately can suffer the blow if some of these investments ultimately fail. Now, the first of these is the Enterprise Investment Scheme. Now, this is a government-approved option, which is all about trying to help companies that are new in the UK to raise money. And in order to do that, they make it much more attractive for investors to put their money into these businesses by offering tax relief. At its simplest, an investor can put an amount of money into a company that qualifies for the enterprise investment scheme. It's usually referred to as EIS. And what they will offer you is 30% income tax relief pretty much straight away. And so what that means is if you were to invest, say, £10,000 into a newly formed company that has its sign off that it's EIS approved, what you can then do is submit a tax return and note on it that you've put £10,000 into this company and a few bits of information to confirm that. And you will immediately get around about £3,000 up front that you can knock off your tax bill. And that is perfectly legal and available to you. The main reason that this is not going to work for everybody is because the very nature of EIS is that these are extremely risky businesses that are funneling this money into. And what that means is there's a high likelihood that they could fail. I think the latest statistics are that 9 out of 10 businesses that are founded ultimately go bust at some point. So you should really go into this with your eyes wide open that even though you might get the 30% tax relief up front, the whole value of your investment could end up failing. Now, to further sweeten the deal for EIS investments, they actually have 4 other perks attached to them. One of those is that any investments made into it also qualify for something called loss relief. So actually, if that business does go bust, you can write off that loss against your income tax bill in a similar way to the income tax relief that you got up front, which again can help reduce the risk. Another benefit is that any investments in EIS companies are actually inheritance tax free. So again, you could be saving a 40% bill there if you're someone who's worried about your IHT bill. Finally, capital gains tax is quite friendly when it comes to EIS. So all of the returns that you receive in terms of capital gains are CGT free, which is great. And also you can actually defer a capital gain by investing it into an EIS approved company. So let's say you had a large capital gain that had happened elsewhere. Let's say it was £100,000 worth of gain that you don't really want to pay the tax on right now. What you could do is invest that £100,000 into an EIS approved company, and in that way, avoid paying the tax that would have been paid on that previous gain. So the next option available to lots of people is a VCT, otherwise known as a venture capital trust. Now, again, these are risky investments. So you want to be someone who's experienced or can really take the blow if the performance is not good. At their core, a VCT is an investment fund. And it tends to invest in really early stage businesses in a similar way to EIS. But the benefit here is that you're kind of spreading your money across a number of different early stage companies, as opposed to being all in one. An investment manager will also be working to try and find some new opportunities for you, which offer the chances for long-term growth. Now, there have been some real success stories of different companies in the VCT world, such as Zoopla or Depop, to name a few, depending if you're into secondhand clothes. Like EIS, you get 30% tax relief up front, and also you get tax-free dividends and growth over the longer term. Now, one of the key elements that I've not mentioned so far are the conditions of these types of investments. And one of the main ones is the holding period that you have to keep them for. These aren't something you can just invest straight into, get your tax relief, and then sell them. You actually need to hold them for a good chunk of time. For EIS specifically, that's 3 years. And for VCT, that's 5 years. So finally, we've landed on our third bucket, which is the solid, legal, and sensible bucket. And I get it, maybe this isn't going to be the most sexy one, but ultimately it's the one that could make the biggest impact for you over your working life. It could reduce the total amount of tax that you pay and ultimately make sure that you have access to funds in retirement or later on in life, which is going to give you choice, which is really the whole point of financial planning. So what this is all about is making use of your best friends, which are pensions, ISAs, and available tax allowances. Now let's look at pensions to begin with, because often they're overlooked as something that's really boring, not that impressive, and just not something we want to get excited by. But for nerds like me, they are hugely powerful. For a pension, you get tax relief at your marginal rate of income tax. So that means that if you're a higher rate taxpayer paying tax at 40%, the benefit you're getting is higher than those slightly more exciting things that I mentioned previously. A pension is better than those in many, many circumstances. In addition to that, all of the investments that are held within pensions grow totally free of tax. And that means that all the returns that you get while you're working away are then benefiting from more returns because they'll be invested and benefiting from compound interest. In addition to that, pensions are called something called a tax-deferred account. And what that means is when you do come to access the money, you will start paying tax at that point. But there are two really important things here to keep in mind. First of all, the first 25% when you access your pension is tax-free. So that means you were getting 100% tax relief on what was going in, but only paying tax on 75% that's coming out. And that's swinging the favor back into your court even further compared to investing outside of a pension. The other consideration is usually when someone comes to access their pension, they will be a lower taxpayer than they were when they were working. It would be very, very rare that someone was going through life being, say, a basic rate taxpayer, paying tax at 20% and your earnings were under £50,000. And then all of a sudden, when you retire, you become a higher rate taxpayer. Something weird would have had to have happened there in order to make that possible. Usually in your working life, you would be a basic or maybe an additional rate taxpayer. And then when you come to retire, you will be a lower taxpayer because generally you'll be living off less when you're retired than when you were earning money. Now, of course, the downside with a pension, in a similar way to the ones previously, is there is a holding period. And what that means is you will need to keep your money in your pension until you retire. It's as easy as that. Under current rules, that's age 55, but that's due to rise to 57 in 2028. And the government is saying that it's likely to then match state pension age minus 10 years beyond that. And because the whole world is living slightly longer, I wouldn't be surprised if that does increase again in the future. Now, next up, we're talking ISAs. ISAs are an absolutely valuable tool to help reduce your tax bill. And the main two types that people tend to use is a cash or a stocks and shares ISA. Now, the beauty of these accounts is that any of the returns or interest that you receive are totally tax-free. Simple as that. And because you're not necessarily getting tax relief on contributions into an ISA, i.e. if you put £100 in, £100 is invested, whereas if you put £100 into a pension, you're going to get more invested, depending on what marginal rate of income tax you are. There really isn't a holding period to be worried about. Ultimately, you can put the money in today and you can withdraw it tomorrow. It's super flexible. And that's why we tend to say that ISAs are the best homes for short and medium term money. Short term, maybe a cash ISA, medium term, a stocks and shares ISA, because then your money's going to have a chance to work really hard for you over a slightly longer period of time. So rounding off the sensible bucket is to make use of your tax allowances. Now, every single person in the UK is allowed to make use of these allowances, which basically means you get money tax-free through the different streams that are available to you. Now, the most common one, of course, is going to be income. So you have a personal allowance, which allows you to receive an amount of money without paying any tax on it. The only exception to this rule is someone that is actually earning in excess of £100,000, where all of a sudden, every £2 that you earn over that, you will lose £1 of your personal allowance. We'll have a separate video on that to actually run through the options to keep that personal allowance. The next tax allowance that's available to you, of course, is the dividend allowance. And what that means is if you hold some investments or you work through a limited company and you receive a dividend payment, you can receive an amount of those totally tax-free every year. Next up is capital gains tax allowance. Again, if you hold shares in something or a property that isn't your main residence, when you come to sell that and it's appreciated in value, you're allowed to keep an amount of that totally tax-free every year. And then finally, the one that most people overlooked, especially because interest rates have been so low over the last 10 years or so, is a personal savings allowance. And what that basically means is the interest that you receive on your savings can sometimes be tax-free depending on what taxpayer you are. So if you're a basic rate taxpayer, i.e. your total earnings are up to about £50,000, then you can actually receive bank interest of £1,000 every year totally tax-free. That's not bad. If you're a higher rate taxpayer, that's £500. And then unfortunately, if you're an additional rate taxpayer, that is £0, i.e. all of your interest will be taxed. So that wraps up a bit of an overview of the tax options that are available to you today in the UK. These can change in the future. The government is always looking for ways to entice people to put money where they want it to go, whether that be newly formed businesses or different parts of the economy. My recommendation to you is to actually move through the buckets in reverse. Start with bucket 3, the really sound, sensible, and well-adopted methods to actually reduce your tax bill. So think about your pension contributions. Are you putting in the right amount? Are you thinking about your tax bill every year and running the numbers as to how much lower it might be if you put more into pensions? Also think about ISAs. They're available to you, and remember, you can withdraw from them the day after you put money in. Then I'd move on to bucket 2. If you're in that position where you've made full use of pension allowance, where you've used up all of your tax allowances and your ISA might be full, but you're still paying a high amount of tax, it's time to start thinking about bucket 2. Investment opportunities like EIS or VCTs could start to make sense, but I would really encourage everyone to at least speak to a financial advisor before taking those out, because they come with serious risks and you want to make sure that they are suited to you. Once you've made use of those, do not think about bucket 1. They come with a huge amount of risk, and as you can see in the headlines, people end up paying the right bill. The last thing that you want is HMRC to be interested in you and your tax return, so make sure that you focus on buckets 2 and 3, and you should be in a good position.